Hello, everybody. This is Bennett Tchaikovsky, and welcome. So we're going to be going through over here our last part of non-current liabilities for intermediate accounting. We're going to be doing some bond modifications where there is a gain to a debtor. Now, believe it or not, this is going to be easier than what we just went through and computed, but we'll have to probably won't believe me until we go through and do it. In any event, my disclaimer and copyright notice is that the information and opinions in this presentation are those of myself and not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. This presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2026 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Throughout the presentation, I will make reference to publicly available information that is the copyright of other parties. I do not claim any right to the copyright of those third parties. So right now we're going to be looking at bond term modification when the debtor has a gain. And again, I kind of went over this in the last video, but the most important thing over here is that when we are going through, is there in fact a gain on the debt restructuring? Well, if the future cash flows, meaning that we're just looking at the cash payments, is less than the carrying value, we're going to have a gain on debt restructuring. Well, let's go ahead and get to this. So again, the question we're going to be looking at here is Jesselnick Industries borrowed money in 2016 from Wells Bank and was owed $12 million as of 12/31/21. Okay, so this is the amount that is owed. Okay. So this is going to be the amount that is basically going to be owed. Now, this is the old amount. The new amount is basically going to be 7 million. That is going to be due on 12/31/24. And then I'm going to have to go through and make three interest payments on 12/31/22, 12/31/23, and 12/31/24. So this is what I'm going to have to go through and do for this. And when we go through and add these up, I get 8,470,000. And so over here, because the 12 million is greater than the basically 8.47 million, we're going to have a gain on troubled debt restructuring. Okay. And the way this is going to work for the debtor is that the debtor is going to basically reduce notes payable by the difference of these two amounts right over here, 12 million minus 8,470,000. And then we're going to be going over here and basically crediting gain on troubled debt restructuring. Again, when you're dealing with this, there will be tax consequences. So 12/31/20 and basically record gain on troubled debt restructuring. Okay. Now with this part over here, what we want to kind of go through and look at is to say, okay, what do the journal's entries look like? Well, for this, we're going to recognize no interest expense. Rather, everything, all payments will be reducing the note payable. Okay, so what does this look like? Well, on 12/31/22, 12/31/23, 12/31/24, in terms of the interest, we're going to basically be debiting notes payable. And we're going to be crediting cash, and this is going to be for the 490,000. And then our last one we can also go through and do, I just always like to highlight this as separately, but we're going to have notes payable and cash over here for the balance of the 7 million that is owed. Okay, and if we look at this from a note payable perspective, right? So here we basically had on 12/31/20, the note payable had a value of 12 million. On 12/31/20, I basically did a reduction to make it 5,530,000, giving us a balance here of 8,470,000. Then I basically had these payments coming out. So basically by the end of this, essentially my ending balance here, if I add up all these amounts here, this is going to go down to zero. So from the debtor side, this is very, very simplistic. However, where this gets to be more challenging is what we just saw kind of in the last example is essentially going to be the creditor side. But let's go ahead and do this. This will be a good review for us to go through and do. So from the creditor perspective, or basically Wells Bank, when we go through and look at this over here, essentially we have our note receivable, and our note receivable is going to be 12 million. Now, what we have to go through and do is we need to be realistic about what we're going to be going through and receiving. What does this mean? Well, we got to use the original interest rate of 10%. Don't use the 7%. We're going to use 10%. And then we're going to go through and then basically say to ourselves, like, okay, we've got this 490,000. So, and I've got 7 million. So over here, we've got present value of basically we have the principal. My new principal is going to be 7 million. What I'm going to do here, I'm going to use present value of $1, 3 periods at 10% because this is being paid 3 years out. So present value of $1, 3 periods at 10% is 0.75131. So the present value of that principal is going to be 2,259,170. And then over here, I'm going to have my next one is that the interest payments. My interest payments are going to be 490,000. I need to use the present value of an ordinary annuity of $1, 3 periods at 10%. So I'm going to go over here, present value of an annuity of $1, 3 periods at 10%. And this is going to be 2.48685. I stopped using 10%, but for some reason I did. Okay, so basically the present value of these is going to be 1,218,000. So my total present value of future cash flows is going to be 6,477,727. So over here, my impairment, or what we like to call basically the bad debt expense, my bad debt expense over here will basically be 5,522,274. So the way I'm going to go through and record this as a journal entry on 12/31/20 is to debit bad debt expense. I'm going to be crediting the allowance for doubtful accounts. And this is going to be over here to record loan impairment. Now, what I like to do with these questions is I kind of like to use T accounts. And this is just going to always kind of help me kind of keep track of things. So over here, I'm going to have my note receivable, basically over here of 12 million. And then I'm going to have my allowance for doubtful accounts, or basically a contra asset account of 5,522 274. Okay. Now, what my goal is with this particular question, right, is that I want this number to ultimately get down to 5 million, right? And why do I want this to get down to 5 million? Because when the amount of the loan, when this is repaid to me, I want this, when the 7 million is repaid to me, I want to basically write this off of my books when I receive that 7 million of cash. Okay. So the way we're going to go through and do this is that on my balance sheet, maybe that's right. Oh, this is 12/31/21. I screwed up. Hold on. Okay. Sorry about that, guys and girls. Okay. So as of 12/31/21, my note receivable less my allowance for doubtful accounts, this is going to be 12 million minus 5,522. Again, I wrote this 5 million in here because when we get to this end point, that's what I'm going to want this to be looking at. Okay, what I want that to be looking like. Okay. Okay. So my note receivable net as of right now is 6,477,727. So over here, I've got my note receivable carrying value of 6,477,727. Okay, so my cash received. So let's go ahead and do 12/31/22, 12/31/23, 12/31/24. Okay, my cash received is basically going to be every single time is going to be 490,000. Okay, so my interest is basically going to be my old interest rate times the carrying value. And then this difference over here is going to go to the ADA reduction. Okay, so my interest expense is going to be this amount times 10%. So my allowance for doubtful accounts reduction for the first period at 12/31/22. So my ending balance here and my allowance for doubtful accounts is going to be 5,364,501. Again, we want this to go down to 5 million, so it is heading in the proper direction. Okay, so my ending note receivable carrying value is going to be 12 million minus the allowance post adjustment, or this amount right over here. Okay, so on 12/31/23, let's go ahead and do this part over here now. My interest expense is going to be at 663,000. So my allowance for doubtful accounts reduction is going to be at 173,550. Now, what does this look like in terms of journal entries? Well, I'm receiving cash of 490,000. I'm recognizing interest revenue over here. Excuse me, this is interest revenue. Sorry. That's what I get for making videos at the witching hour. So my interest revenue over here is 647,773. And so then this is going to go to my allowance for doubtful accounts. Okay, then over here, cash is never going to come over here and change. I'm always receiving that money. But then over here, my interest revenue is going to be this part over here. And then my ADA reduction will be right below it, right over here. So now coming over here for my last part, get my note receivable carrying value is now going to be 12 million, basically minus 6,809,49. My interest revenue, 689,05. And my last reduction for my accounts, my ADA reduction is basically going to be 199,05. And I already know my goal was to get this to be at 5 million. So I'm just going to go ahead and add, just going to note this here. Okay. So my note receivable carrying value is going to be at 7 million, or the face amount minus the allowance amount over here. So again, my AR, my allowance for doubtful accounts reduction is going to be right over here. My interest expense, my interest revenue is going to be right over here. So I need to also probably go through and adjust this, but that's okay. So let's go ahead and do this anyways. This should be 680,951. Okay. So now the last thing I have to go through and do, so this is to record interest revenue. And then lastly, when I actually receive the money from the client, I'm going to be debiting cash, crediting notes receivable. And I'm also going to be debiting the allowance for doubtful accounts. Okay, so right over here, and this would be on 12/31/24. So I'm receiving a total amount of 7 million. My allowance for doubtful accounts is going to be here at 5 million. I need to get rid of that. And then over here, my note receivable would be at 12 million, right? So debiting allowance is going to bring that amount down to zero. I'm crediting the note receivable. That will also go down to zero. So right over here, payment. So again, as I mentioned before, if I do go through and give this to you on an exam, if you're taking my class, I will be giving this as an extra credit component question. But again, the key thing here is if you've got trouble debt restructuring, there's no more interest expense. It's all reducing the principal. If there is in fact a gain, right? If there, and this is again going on the straight up, you're comparing absolute dollars to the amount that was owed. In this case, unlike the last example, it was less. So for the debtor, it's pretty straightforward. It's much easier than the last one we were going through and doing. But for the creditor, it's always going to be, I got to recognize that amount, that basically that difference or that loss, bad debt expense. And that's how we're going through and doing it. So right over here, that goes to this question. So in any event, thank you for watching here today. Please like and subscribe. It helps out the channel. Actually, I don't really know how it really helps out. It just seems to be kind of, but maybe someday soon. Please feel free to leave me a comment or send off an email to me at IBC30 CPA if there's other questions you have about this content or want to see other things. In any event, thank you for being here today, and I look forward to seeing you on future videos. Have a great day.